So there is one number on your mortgage application that decides more about your budget than your credit score, your down payment, or the rate that you get. It's your debt to income ratio. And here's the part that should get your attention. It's the one thing on that whole application you can actually move before you apply. And most people never even touch it. So if your pre-approval came in lower than you expected, or someone told you your number was too high and left it there, stay with me because I'm going to show you exactly how this works and how to shift it into your favor. Debt to income, or DTI, is just a percentage. It is how much of your monthly income already goes out the door to bills. If you make $10,000 a month before taxes and $4,000 of it goes to debt payments, your DTI is 40%. That is the whole formula. Take your monthly debts, divide by your gross monthly income, and that is your number. Now, if you have not watched my affordability video yet, the one on how much the house you can actually afford, I'll link it below. This one builds directly on that. That video gives you your number. This one shows you how to move it. Now, let me clear up something that trips almost everyone up. There are actually two DTI numbers. The first is called front end. That one only looks at your future house payment. The second is back end, obviously, and this is the one that really matters because it counts everything. Your car loan, your student loans, your credit card minimums, and the new house payment all stacked together. And when a lender says that your DTI is too high, they almost always mean the back end number. And here's where it gets interesting because not every loan treats the number the same way. Conventional loans usually want to see your back end DTI under about 43 to 45%. And some will stretch to 50 if the rest of your file is strong. FHA loans tend to allow more room, and VA loans work differently altogether. The VA does not set a hard cap at all. Instead, it leans on something called residual income, which is just the money left in your pocket after every single bill is paid. A veteran with strong residual income can go well past 41% and still be just fine. Same borrower, same debts, 3 different answers depending on the loan. And that is why the loan you choose is part of the strategy, not an afterthought. Now, let me pull back the curtain a little bit on what actually counts as debt, because this surprises people. Your rent, your groceries, your gas, your Netflix, your phone bill, none of that counts. Lenders only count the debts that show up on your credit report, plus a few others like child support or maybe alimony. So that $700 a month car payment counts against you. Your $400 grocery bill does not. That distinction is the whole game, and it is exactly why you have more leverage here than you actually think. So here's a scenario. Say a buyer makes $8,000 a month before taxes. They've got a $600 car payment, $300 in student loans, and $150 minimum on a credit card. That is $1,050 in debt before they have even added on a house payment. On paper, their pre-approval comes in for less house than they wanted, and they walk away thinking that they're stuck. But they're not stuck. They just do not know which levers to pull. So let me give you 3 real moves, and I'm going to build the strongest one first. Move 1, pay down revolving debt, meaning credit cards, not to zero necessarily, but strategically. On a credit card, the lender counts your minimum payment. Knock that balance down and the minimum drops, and your DTI drops with it. So even a modest pay down on the right card can free up some real room. Move number 2, look at installment loans that are almost done. Here's something a lot of people do not know. If your loan has 10 or fewer payments left, many loan programs will let you leave that payment out of your DTI entirely. So sometimes making a couple extra car payments to get under that line does more for your buying power than paying off a whole credit card. And here's the one move that moves a needle the most, the one that I saved for last. It is not always about paying down debt at all. Sometimes it's about the income side or picking that right loan. Remember, VA uses residual income instead of a hard cap. A conventional loan might reject that exact same file that an FHA loan approves. Adding a co-borrower with income and little debt can reshape your whole ratio. The point is this: your DTI is not one fixed number. It is a number you and the right lender shape together before you ever submit. One quick note for the investors watching. If you are buying a rental, there is a whole different track called a DSCR loan where the property's rental income qualifies a deal instead of your own personal DTI. That is its own conversation, but just know that it exists. Now, most lenders give you a rate. I give you a strategy. And when it comes to DTI, the difference between knowing your number and knowing how to move it is the difference between the home you want and the home you settle for. So here's what I want you to do. If you have been told that your DTI is too high or your pre-approval came in lower than you expected, schedule a free strategy call before you give up on the home that you actually want. There may be more room to move than you actually think, and the link is right below. And if this helped you finally understand the number, subscribe, because I break down the stuff that actually changes what you can buy one video at a time. I'll see you on the next one.